Imagine looking at a medical business where the actual number of patients walking through the doors is just completely flat.
Right, like no growth at all.
Exactly. I mean, They aren't growing their clinical footprint. And in fact, management is projecting slightly negative volume growth for the first quarter of the coming year.
Yeah, the core physical business is essentially just treading water.
Right. But then, in the very same breath, on the exact same earnings call, the CEO looks at Wall Street and promises this staggering 33% explosion in adjusted earnings per share.
To the upcoming year, yeah.
33%. I mean, how on earth does a company with stagnant patient volume confidently project a massive jump in per share profit like that?
Well, it's sort of the ultimate paradox of mature, highly regulated industries.
Okay, how so?
You're basically looking at a classic divergence between the clinical reality and, frankly, financial engineering.
Yeah, that makes sense.
And like in the case of DaVita, analyzing this quarter requires us to strip away all that corporate gloss. We have to look at the actual plumbing of both their clinics and their balance sheet.
And that is exactly our mission today. We are putting on our Talk Tickers hats for DaVita, ticker symbol DVA.
Right.
We're doing a full deep dive into their Q4 2025 earnings call. Because, for the retail investor holding this stock or maybe looking to buy in, reading a transcript filled with acronyms like ESRD.
Yeah, IKC, RPT.
Right. It can feel like trying to decipher a foreign language while blindfolded. So we're going to cut through the Wall Street jargon, highlight the most critical data points, and give you, the listener, an actionable take on what this actually means for your portfolio.
And we're going to do it by focusing heavily on the mechanisms.
Yes, the how and the why.
Because, look, corporate management teams speak to institutional analysts, right? Analysts who spend like 80 hours a week modeling cash flows. They don't usually stop to explain the biological or operational realities that are actually driving those numbers.
No, they definitely do not.
So our goal is to connect the financial outcomes directly back to the clinical mechanisms.
Let's jump right into it then. Let's start with the sheer scale of the numbers they posted, because despite that flat volume we talked about, the financial engine here is just roaring.
Oh, absolutely roaring.
Full year 2025 adjusted operating income came in at $2.094 billion.
Wow.
Yeah, and $586 million of that was generated just in the fourth quarter alone. Adjusted EPS was $10.78. But the number that really, jumps off the page for anyone valuing this company is the free cash flow.
Right, that's the big one.
They blew past the $1 billion mark for the year. And I mean, they did this while dealing with a massive cyber incident that dominated the headlines.
Yeah, that cash flow is honestly the entire thesis for holding a stock like DaVita. I mean, to understand how impressive that $1 billion is, you have to contextualize the environment they were operating in.
Right.
They managed to hit the top half of the original guidance range they gave Wall Street 12 months prior. And they did that despite experiencing just a crippling disruption to their revenue cycle.
Let's talk about that, because the transcript mentions this cyber incident repeatedly.
Yeah, it was everywhere.
Now, obviously, a hack is bad news, but I really want to understand the actual mechanics of the damage here. Like, my initial thought when I hear cyber incident in healthcare is data privacy.
Right. Patient records getting stolen, IPA violations, that sort of thing.
Exactly. But looking at the financials, this wasn't really a HIPAA penalty issue. This was a fundamental block in their cash pipeline.
That's a great way to put it.
It's less like crashing a plane and honestly more like someone suddenly freezing the water pipes in your house. Like the reservoir, the patients, is still full. And the faucets, the clinics, are still open, but the plumbing connecting them to the brunt account is totally blocked.
That is a highly accurate way to visualize it. Because look, in the medical billing world, a clinic doesn't just hand a patient a bill and get a check before they leave.
Right, it's way more complicated than that.
They rely on massive digital clearinghouses to submit claims to Medicare, Medicaid, and like thousands of different commercial insurance plans. So when a major clearinghouse goes down, which we saw with those broader systemic hacks recently, the clinics are still physically providing dialysis.
They have to. I mean, dialysis is life support.
Exactly. You can't just pause a patient's treatment because the Wi-Fi is down or a server crashed.
So they are out there still paying the nurses. They're still buying the dialysate fluid, keeping the lights on. But the insurance companies just aren't sending the reimbursement checks.
Basically, yeah. I mean, well, I shouldn't say exactly because it's always messier than that. But the cash conversion cycle just grinds to an absolute halt.
The day sales outstanding just goes through the roof.
Right. the time it takes to collect payment spikes. For a smaller medical practice like a mom-and-pop clinic, a 45-day delay in cash flow means bankruptcy.
Oh, absolutely. They can't make payroll.
But what DaVita proved in 2025 is the absolute resilience of their balance sheet. They had the liquidity to just absorb the shock, continue operations, and eventually unfreeze those pipes to collect all that backlogged revenue.
And still netted out $1 billion in free cash flow, which is wild. But, generating $1 billion in cash despite a frozen revenue cycle is impressive, but it really begs the question.
Where is it coming from?
Yes. Where is that cash actually coming from on a per patient basis? Because when you look at what they charge versus what it costs to treat someone, the margins seem incredibly tight.
Very tight.
The CFO noted that revenue per treatment, or RPT, actually accelerated in the fourth quarter. It went up roughly $12 sequentially, finishing the year at about $410 per treatment.
Yeah, that 4.7% annualized increase in RPT is a vital metric to watch. In a flat volume environment, pricing power is basically your only lever for organic revenue growth.
Right. If you aren't getting more patients, you have to charge the ones you have more.
Exactly. And the CFO outlined a few drivers for this. But it requires parsing out what is a one-time benefit versus what is actually structural. First, they cited the resolution of aged receivables.
Let me jump in there because I always view that phrase aged receivables with a bit of skepticism.
Oh, for sure.
Because if they are just finally collecting on old bills from last year that were stuck in dispute or, delayed by the cyber incident, that provides a sudden cash infusion for Q4, but it's not a sustainable pricing increase.
Wait, it's not repeatable.
It's like finding uncashed checks in a drawer. It boosts the quarter, but it doesn't mean your actual salary went up.
Yeah, it is a non-recurring tailwind. You cannot model that out into 2026.
Yeah.
However, the second and third drivers they mentioned actually are structural and highly critical.
Okay, what were those?
They negotiated standard rate increases with their commercial payers, and they saw a slight improvement in their private pay mix. And to truly grasp DaVita's business model, you really have to understand the extreme dichotomy of their payer mix.
Yeah, I know from analyzing hospital operators for talk tickers that Medicare generally pays less than private employer-sponsored insurance.
Right.
But in the dialysis industry, my understanding is that the disparity isn't just a slight margin difference, it's an existential necessity.
It is the defining feature of the entire industry. Let's look at the history for a second, just to set the stage. In 1972, the U.S. government essentially created a universal healthcare entitlement specifically for end-stage renal disease.
Right.
If your kidneys fail, Medicare covers your dialysis, period, regardless of your age.
Oh, wow. So it's not just for people over 65.
Nope. It's a massive, incredibly expensive government program.
Yeah.
So over the decades, to control those runaway costs, CMS, the Centers for Medicare and Medicaid Services, implemented a prospective payment system.
Okay. Plain language translation, what does that mean for DaVita?
It means they pay a single, highly constrained bundled rate per treatment.
Meaning DaVita gets a flat fee from the government, regardless of how complicated that specific patient's treatment is on any given day.
Right. And that government rate is so notoriously tight that the margins on Medicare patients for DaVita are often zero.
Zero.
Or even slightly negative once you factor in clinic overhead, depreciation on the machines, corporate administration. They basically treat Medicare patients at cost.
Wait, so the entire profit engine of the company relies on what, the private insurance side?
Exactly. It relies on the small percentage of patients, usually hovering right around 10%, who are still covered by private commercial insurance before they transition fully onto Medicare.
Wow. So that 10% of commercial patients is heavily subsidizing the other 90%.
Heavy subsidization. Commercial insurance must be paying a massive premium over the Medicare rate. In some cases, we're talking 3 to 4 times the Medicare rate per treatment.
Okay, so when the CFO announces that their private pay mix improved slightly in the fourth quarter, investors breathe a massive sigh of relief.
Oh, absolutely. A shift of even 0.5% toward commercial pay can drop tens of millions of dollars straight to the bottom line. It is arguably the most sensitive metric in their entire revenue model.
Which naturally brings us to the cost side of the equation, because you can have the best payer mix in the world, but if your supply costs are spiraling out of control, that margin just evaporates.
Right. It doesn't matter how much you make if you're spending more.
Patient care costs per treatment jumped by $6 sequentially in Q4, and they finished the year almost 6% higher. Management blamed typical wage inflation and employee health benefit costs, which, is standard macro stuff right now.
Yeah, everyone is dealing with that.
But there's a very specific phrase the CFO used that really caught my eye. He said half of the entire year-over-year cost increase was driven by, quote, binders in the bundle.
Yes. That phrase is a perfect illustration of regulatory risk in healthcare. Binders refers to phosphate binder medications.
Okay, I want to pause here because this is where Wall Street analysts usually glaze over the biology.
Yeah, they just see a line item.
Exactly. But I think the biology is the actual key to the financial risk here. Why are dialysis patients taking phosphate binders, and why is it suddenly costing DaVita so much money?
Okay, so when a patient's kidneys fail, they lose the ability to filter excess phosphorus out of their bloodstream. And phosphorus is in almost everything we eat.
Like what?
Dairy, meat, nuts, even basically all food preservatives. And if phosphorus builds up in the blood, it pulls calcium out of the bones, leading to severe cardiovascular calcification.
Oh, geez.
Yeah, the patient's blood vessels literally harden into bone, which is a primary reason dialysis patients suffer from fatal heart attacks.
That's terrifying.
So to prevent this, patients have to take massive pills called phosphate binders with every single meal. The binders act like a sponge in the gut, right? They bind to the phosphorus in the food so it gets excreted before it can even be absorbed into the blood.
Okay, so these are absolutely critical life-saving drugs. But historically, DaVita didn't pay for them, right? Like, the patient got them from a pharmacy through their Medicare Part D prescription drug plan.
Historically, yes, that's exactly right. It was entirely separate from the dialysis clinic's financial statement.
Mm-hmm.
But CMS has been on a decade-long crusade to consolidate ESRD costs.
Whoa, okay.
The government decided to move the cost of these phosphate binders into the core ESRD prospective payment bundle. They essentially told DaVita, hey, we're going to give you a slight bump to your flat fee per treatment, but now you are entirely financially responsible for sourcing and providing these binder medications to the patients.
I see. So the government just shifts the supply chain risk directly onto the provider.
Exactly.
If the pharmaceutical companies raise the price of these binders, or if a patient requires a massive dosage because of their specific diet, DaVita eats that cost directly. CMS completely washes its hands of the price volatility.
That is the exact mechanism at play. And that is why the CFO had to report that 50% of their massive cost increase year over year was just from absorbing these drugs.
Wow.
It's a really sobering reminder for any investor. In a heavily regulated medical monopoly, the government can wipe out a year's worth of margin improvements with the stroke of a regulatory pen.
And it wasn't just the regulatory pen that hit their margins. We have to account for the lingering damage of that cyber incident we talked about earlier.
Right, the financial hangover.
The CFO actually quantified the final tally as a $70 million hit for the year. He broke it down as $25 million in permanently lost volume.
Which is patients who went to competitors during the outage and just aren't coming back.
Exactly. And a $45 million hit to their revenue per treatment from billing inefficiencies. Honestly, absorbing a $70 million exogenous shock and still growing free cash flow really reinforces your point about the durability of this cash engine.
It really does. But defending the core dialysis business is, well, it's only playing defense.
Right.
If you want to understand where management thinks the future growth is coming from, we have to look at a major milestone announced on this call regarding their integrated kidney care division, or IKC.
I was hoping we would get to this. The CEO sounded incredibly proud of this on the call. He noted that for the first time ever, the IKC segment hit profitability.
Yes. Big moment for them.
They generated $3.5 million in adjusted operating income for the full year, with $46 million of that coming in the fourth quarter alone. He even boasted that this was slightly ahead of the 5-year schedule they gave Wall Street back in 2021.
Right.
But honestly, as a retail investor, I am deeply confused by the fundamental premise of IKC.
Okay, walk me through the confusion. What's the disconnect?
Well, historically, DaVita is a fee-for-service brick-and-mortar operation.
Right.
A patient's kidneys fail, they walk into a clinic 3 days a week, and DaVita bills for a 4-hour treatment. Volume equals revenue.
Yep, that's the traditional model.
So if the entire goal of this integrated kidney care program is to manage patient health upstream, to keep them healthier, keep them out of the hospital, delay the progression of their kidney disease, or even help them get a transplant, doesn't that fundamentally cannibalize their core clinic business?
Oh, I see where you're going.
Yeah. Why would I invest in a company that is actively trying to reduce the need for its own primary product?
You are hitting on the core tension on the stock. And honestly, it requires a deep dive into the mechanics of value-based care.
Let's do it.
Under the old fee-for-service model, you were absolutely right. The incentive structure was entirely misaligned. A clinic basically got paid more if a patient crashed into the emergency room and needed emergency dialysis.
Which is terrible for the patient.
Awful. And the macroeconomic reality is that end-stage renal disease consumes roughly 1% of the entire federal budget. The government realized that waiting for patients to catastrophically fail and then just paying for unlimited unmanaged volume was literally bankrupting the system.
So the government forced a change in the financial incentives.
They introduced shared savings models. Under IKC, DaVita goes to CMS or a private commercial health plan and strikes a very different deal.
What does that deal look like?
They say, let us take total holistic management of this patient before their kidneys completely fail. They'll send dietitians to their house, they manage their complex medication regimens, they coordinate with their cardiologists.
So they are doing all this preventative work.
Exactly, and they take on the upfront financial risk to do it. But if DaVita successfully keeps that patient out of the emergency room and delays their need for emergency interventions, the total cost to the healthcare system drops by hundreds of thousands of dollars per patient.
And under a shared savings contract, DaVita gets to keep a percentage of the money they save the government.
You've got it.
They get paid for the clinical outcome, not just the raw volume of dialysis treatments.
Right. And the clinical statistics the CEO shared to prove this model is working are actually staggering.
Oh, like what?
He noted that patients in their IKC program are 35% more likely to start dialysis with a permanent vascular access rather than a central venous catheter.
Okay, this is another area where I need the plain language medical translation. What is the difference between a permanent access and a catheter? And why does the 35% increase in the former matter to the bottom line?
It is arguably the most important clinical metric in all of dialysis. Let's look at the pathophysiology of a crash start.
A crash start?
Yeah, that's what they call it. If a patient hasn't been receiving coordinated care, their kidneys will eventually shut down suddenly. They arrive at the emergency room in acute failure, literally drowning in their own fluids.
Wow.
To save their life, a surgeon has to immediately jam a large plastic tube, a central venous catheter, directly into a major vein in their neck or chest to connect them to the dialysis machine.
That sounds incredibly invasive and dangerous.
It is highly dangerous. Those catheters act as a direct superhighway for bacteria to enter the bloodstream. Patients with catheters have astronomically high rates of sepsis and endocarditis, which are infections of the heart valves.
So that leads to more hospitalizations.
Exactly. Treating a dialysis patient for a catheter-related bloodstream infection often requires a multi-week stay in the intensive care unit. It is agonizing for the patient, obviously, and catastrophically expensive for the insurance company.
So what does the IKC program do to prevent that?
The alternative is a permanent vascular access, typically something called an arteriovenous fistula, or AV fistula.
Okay.
A surgeon connects an artery directly to a vein in the patient's arm. The high pressure from the artery forces the vein to dilate and thicken over several months.
I see.
Once it matures, it is a robust, natural access point for the dialysis needles. It has a fraction of the infection risk of a neck catheter. But here is the catch: a fistula takes months of advanced planning and surgical maturation before it can actually be used.
So you can only get a fistula if someone is managing your health upstream, predicting when your kidneys will fail, and getting you to a vascular surgeon like 6 months ahead of time?
Which is exactly what the IKC program does.
Okay, the pieces are coming together.
The CEO stated that starting dialysis with a permanent access results in overall healthcare costs that are 3 times lower during the first 180 days of treatment.
3 times lower.
We are talking about saving tens of thousands of dollars per patient simply by avoiding the emergency room and the inevitable catheter infections.
That perfectly answers my cannibalization question from earlier. They aren't cannibalizing themselves. They are diversifying the monetization of the patient.
Right.
If the patient transitions smoothly to a clinic, DaVita might lose out on a few chaotic emergency fee-for-service billings, but they collect a massive shared savings check from the government for keeping the patient out of the ICU.
And by crossing the profitability threshold in 2025, they proved this isn't just like some idealistic white paper theory. They proved the unit economics actually work at scale.
Yeah, that's huge.
They are projecting an incremental $20 million of operating income growth from the IKC segment alone next year. It forces investors to reevaluate what DaVita actually is. They are trying to transition from being a static landlord of medical equipment into a dynamic population health manager.
That is a very compelling narrative, but let's be real, IKC is still a very small slice of the overall revenue pie right now.
Oh yeah, tiny.
To understand how they are projecting that massive EPS growth we talked about, we need to look at management's actual guidance for 2026. This is where we solve the riddle we brought up at the very beginning of the show.
Let's lay out the exact parameters management provided.
First, they're projecting adjusted operating income to come in between $2.085 billion and $2.235 billion. Taking the midpoint of that range, you are looking at a 3.2% growth over 2025.
Which is not exactly explosive.
Right. It's a very modest, sluggish, single-digit growth rate. It reflects exactly what you'd expect from a mature, utility-like business operating in a flat volume environment. They also projected free cash flow to remain strong, between $1 billion and $1.25 billion.
Yep.
But then right alongside that 3.2% operating growth, they guided for an adjusted EPS of $13.60 to $15.0. At the midpoint, that is a 33% jump from last year.
It's a huge disconnect.
I was looking at their cash flow statement, and it looks like they are violently attacking their outstanding share count. They spent $1.8 billion on buybacks. That has to be manipulating the EPS denominator, right?
Well, manipulating might have a negative connotation, but you are absolutely zeroing in on the primary mechanism here. It is textbook financial engineering.
Right.
And honestly, if you are holding this stock, you are paying this management team to be exceptional allocators of capital. You have to look at their capital allocation matrix.
How does that work in practice?
They generate over $1 billion in free cash flow, right? They look at the organic growth opportunities in the physical clinic space and realize the return on invested capital there is low because, as we established, volume is flat.
So building a bunch of new clinics makes no sense.
Exactly.
Yeah.
So what is the most accretive thing they can do with that cash? They buy their own stock.
By taking 13 million shares off the open market in a single year, every remaining share claims a significantly larger slice of that $2.1 billion operating income pie.
Yes.
The business itself only grew by 3%, but your individual ownership stake in that cash flow just grew substantially because there are literally millions of fewer slices.
The math works perfectly.
But there's a specific dynamic to their buyback strategy that I found absolutely wild in the transcript. The CFO explicitly mentioned that a portion of their share repurchases are done directly from Berkshire Hathaway.
The Berkshire dynamic is fascinating. Warren Buffett's holding company is a massive long-term shareholder in DaVita.
Okay, so what's the issue?
Well, there is a structural problem when a company aggressively buys back its own stock while a major shareholder just sits on their hands. If DaVita is constantly buying and retiring shares from the public market, the total denominator shrinks.
Right.
So if Berkshire doesn't sell any of their shares, their percentage ownership of the company naturally creeps up, purely by mathematical default.
And I imagine once a single entity owns more than half of a publicly traded healthcare company, the regulatory alarms start blaring.
Oh, absolutely. The SEC and banking regulations become incredibly complex. If Berkshire crosses certain ownership thresholds, they could be forced to consolidate DaVita onto their own balance sheet or face intense regulatory scrutiny regarding control of a critical healthcare asset.
They definitely don't want that.
No. So to avoid this, DaVita has a publicly filed agreement with Berkshire. The CFO noted it formulaically ensures Berkshire's ownership remains at or below 45%.
So they basically have a standing order, like, for every batch of stock we buy from the public, we are going to buy a proportionally identical batch directly from you, Warren, so your ownership stake never inches past that 45% line.
Yep, it is a perfectly choreographed financial dance.
But buybacks alone can't bridge the entire gap to 33% EPS growth. I saw they also aggressively targeted their debt.
Yes. The second major lever is optimizing their capital structure. The CFO stated they expect their debt expense to decline by $20 to $40 million in 2026.
Which is a big chunk of change.
Right. And if you look at their balance sheet, they ended the year with a leverage ratio of 3.26 times their consolidated EBITDA, which management noted is comfortably in the middle of their target range of 3 to 3.5.
In a higher interest rate environment, carrying significant corporate debt can just crush earnings. How are they reducing the expense by up to $40 million without drastically paying down the principal?
It comes down to their weighted average cost of capital, or WACC, and their ability to aggressively reprice their term loans.
Okay, break that down for me.
DaVita has been highly proactive in refinancing their existing debt to secure lower interest rate spreads. They go to the credit markets, prove the extreme stability of their billion-dollar cash flow, and essentially negotiate a lower interest rate on their corporate mortgage.
Wow.
Dropping an extra $20 to $40 million in saved interest straight to the net income line provides a massive boost to the EPS numerator without having to treat a single extra patient.
That is pristine corporate finance. And there was a third lever mentioned, something called Mozark, which the transcript barely glossed over but seemed to provide a noticeable accounting bump. What is the actual mechanism there?
The Mozark situation is a great lesson in joint venture accounting. Mozark is a separate entity that DaVita formed in partnership with Medtronic.
Oh, the medical device company.
Right. They partnered to research and develop new kidney care technologies. Startups in the medtech space burn phenomenal amounts of cash in their early years. Because DaVita is a primary stakeholder, they had to absorb their proportional share of those financial losses on their own income statement.
So Mozark's R&D burn was actively dragging down DaVita's quarterly earnings.
It was. But under equity method accounting, you only recognize losses up to the amount of your initial investment. The CFO noted that DaVita has now recognized cumulative losses equal to their total investment in Mozark.
So they hit the floor.
Exactly. They've essentially written the asset down to zero on their books. The mechanism here is that going forward into 2026, DaVita no longer has to drag those Mozark losses onto their P&L.
It's pure addition by subtraction. Just by stopping the accounting bleed from the joint venture, their year-over-year earnings comparison looks significantly better.
Yep.
So you combine these three levers: violently shrinking the share count denominator, aggressively repricing debt to lower interest expenses, and stopping the Mozark accounting losses.
And boom.
You engineer a 33% jump in per share profit from a business that is barely growing its physical footprint.
It proves that as an investor, you aren't just analyzing the clinical product right. You are underwriting the CFO's ability to manipulate the capital structure. But, to your point, financial engineering does have a shelf life.
It does.
You cannot buy back stock forever if the underlying business begins to continuously contract. Eventually, management has to address the actual volume of human beings walking into their clinics.
And this is where the transcript gets incredibly sobering. The core U.S. dialysis volume is projected to grow at a sluggish 1.5% next year. I assumed at first this was a macro demographic trend, like maybe people are getting healthier, maybe the incidence of chronic kidney disease is dropping.
I wish that were the case.
Right, but that isn't the case at all, is it?
Unfortunately, no. The incidence of diabetes and hypertension, which are the primary drivers of chronic kidney disease, continues to rise globally. The pipeline of patients heading toward kidney failure is completely full.
What's the issue?
The headwind driving the flat volume is entirely clinical, and it is a stark reality of this specific patient population. The CEO cited elevated mortality as the primary force putting downward pressure on their treatment census.
So the patients are passing away at a rate that offsets the new patients coming in.
Yes.
It's a tragic dynamic. How does a corporate management team address a mortality headwind? The transcript outlined a few clinical initiatives, starting with basic public health measures like vaccinations.
It sounds overly simplistic for a multi-billion-dollar corporation to focus on flu shots, but the data is undeniable.
What did the data say?
They share that patients who received their flu and pneumonia vaccinations early had a 27% lower risk of mortality compared to their unvaccinated peers.
27% just from a flu shot.
Think about it. A dialysis patient's immune system is incredibly compromised. A common respiratory virus that would keep you or me in bed for 3 days can easily put a dialysis patient in the ICU.
Wow, that really puts it in perspective.
Getting their clinic vaccination rates back above 90% is quite literally a matter of life and death, and it directly protects their patient volume.
But the clinical initiative that absolutely dominated the Q&A portion of the call was the discussion around GLP-1 adoption.
Oh yeah, you can't have a healthcare call without talking about GLP-1s right now.
Drugs like Ozempic, Wegovy, Mounjaro, everyone knows them as weight loss miracles, but what is the actual clinical mechanism that makes them so relevant to a dialysis provider?
This is arguably the most important paradigm shift in nephrology right now. To understand why DaVita cares about GLP-1s, you have to understand what actually kills dialysis patients.
It's not the kidney failure itself.
It is rarely the kidney failure itself.
Yeah.
The number one cause of death in this population is cardiovascular disease.
Ah.
The systemic inflammation, the fluid overload, the calcification of the arteries we discussed earlier with the binders, it absolutely batters the heart.
So where do the GLP-1s come in?
The CEO noted that a growing body of robust clinical evidence, like the recent SELECT trial, confirms that GLP-1 receptor agonists significantly reduce MC, or major adverse cardiac events.
Because they help the patient lose weight.
Not just that, these drugs don't just suppress appetite, they profoundly reduce systemic inflammation and improve endothelial function in the blood vessels. DaVita is actively encouraging their clinic nephrologists to help patients navigate the complex prior authorizations to get on these drugs.
Because if the drug protects the patient's heart from failing, the patient survives longer, their quality of life improves dramatically, and from a purely clinical operations standpoint, they remain on service at the clinic for years longer.
Exactly. It is a rare, perfect alignment of patient outcome and corporate financial incentive.
That's fascinating. The CEO is adamant that getting back to their historical goal of 2% organic volume growth is entirely dependent on this clinical story playing out over the next few years. They also mentioned rolling out new dialysis technologies inside the clinics, specifically highlighting medium cutoff dialyzers and hemodiafiltration.
Yeah, that was a highly technical section of the call.
It sounds great in a corporate slide deck, but how does that actually work in human biology? What is a medium cutoff dialyzer, and how does hemodiafiltration differ from whatever they are doing right now?
Let's look at the physics of dialysis. Standard hemodialysis relies primarily on diffusion.
Okay.
Blood flows on one side of a semi-permeable membrane, and a cleaning fluid called dialysate flows in the opposite direction on the other side. Small, toxic molecules like urea passively diffuse across the membrane from an area of high concentration in the blood to low concentration in the fluid.
So it's basically a chemical gradient doing the work.
Yes, and standard dialysis is very good at clearing small molecules, but it is terrible at clearing middle molecules.
The middle molecules.
Larger, heavier toxic proteins like beta-2 microglobulin. When these middle molecules build up over years of dialysis, they deposit into the patient's joints and heart tissues, causing a condition called dialysis-related amyloidosis, which is crippling and often fatal.
Wait, so standard filters don't catch these?
Right, they don't. They let the middle molecules slip right through. The standard filters just aren't porous enough to catch the bigger debris.
Okay, I see.
A medium cutoff dialyzer simply has slightly larger pores, designed specifically to let those dangerous middle molecules escape without letting vital blood proteins like albumin leak out.
And what about hemodiafiltration?
Hemodiafiltration takes it a step further. Instead of just relying on passive diffusion, it uses convection. The machine actively pushes large volumes of fluid under pressure directly into the blood, dragging those heavy middle molecules across the membrane through sheer mechanical force. It's called solvent drag.
It's like using a high-pressure power washer instead of just letting the hose run over the driveway.
That is the perfect mechanical analogy. Yeah. The CEO noted that adopting these advanced filtration techniques shows promise of reducing overall mortality by as much as 20%.
20%.
Better physics leads to better biology, which leads to a stabilized patient census.
So, vaccinations, GLP-1s to protect the heart, and advanced high-pressure filtration to clear the heavy toxins, that all happens inside the brick-and-mortar clinics. But the biggest strategic move they announce takes them entirely outside of their core competency.
You're talking about the home health acquisition?
Yes. They announced a $200 million minority investment in a company called Alara Caring. And let me push back on this heavily.
Go for it.
DaVita is fundamentally a commercial real estate operator that houses highly complex medical equipment. Alara Caring is a home health care, personal care, and hospice provider. Sending nurses driving through traffic to visit patients in their living rooms is a completely different logistical beast than managing a centralized clinic. Doesn't this expose them to massive execution risk?
The execution risk of managing a decentralized home health workforce is massive. You are absolutely right. The turnover rates for home health aides are notoriously high, and the logistics are a nightmare compared to a static 50-chair clinic.
So why do it?
However, you have to view this $200 million investment through the lens of that IKC shared savings program we discussed earlier.
The value-based care initiative to keep patients out of the hospital.
Yes. The CEO pointed out that roughly a quarter of DaVita's patient population already utilizes some form of home health service. Maybe they need wound care or physical therapy after a fall.
Right.
The strategic logic here is integration. If a highly vulnerable dialysis patient slips in their bathroom or gets confused and takes the wrong dose of their blood pressure medication, they're going to end up in the emergency room by the end of the day.
And that hospital admission instantly destroys the profitability of DaVita's value-based care contract for that patient.
So by owning a stake in Alara Caring, DaVita wants to build out an end-stage kidney disease-specific home care force. They want their own specially trained nurses doing the home visits, checking the blood pressure, checking the vascular access site, and intervening at the first sign of trouble before the patient ever even dials 911. It is the ultimate defensive mode for their value-based care profits. They are willing to take on the logistical headache of home health because the financial penalty of uncontrolled hospitalizations is so much worse.
Makes sense.
It is a massive strategic pivot to capture the entire life cycle of the patient beyond just the 4 hours they spend attached to the machine in the clinic.
That brings us to the bottom line. We have unpacked the frozen pipes of the cyber incident, the biology of the bundle, the shared savings of IKC, the intricate financial engineering of the buybacks, and the clinical shift toward GLP-1s and home health.
We covered a lot of ground.
For the retail investor sitting at home, looking at their brokerage account, what is the actionable verdict on this stock?
I will take a definitive position. For the value-focused retail investor, this earnings call is a cautiously bullish signal.
Break down the bull case first. If I am buying DVA today, what is my core thesis?
Your thesis is that you are buying a company with an impenetrable economic moat, generating highly predictable utility-like cash flows. You are not buying a hyper-growth tech stock.
Obviously not.
You are buying a masterclass in capital allocation. You are betting that the management team will continue to take that $1 billion in annual free cash flow and ruthlessly deploy it to shrink the outstanding share count and optimize their debt structure.
Right.
As long as they execute on those financial levers, they have proven they can manufacture double-digit EPS growth out of a stagnant physical footprint. It's a classic durable value play.
The financial plumbing is pristine, I'll grant you that. But the word cautiously is doing a lot of heavy lifting in your verdict. Let's look at the bearish risks hiding in the shadows of this transcript. You can't financially engineer your way out of a shrinking market forever.
The caveat is entirely focused on the top-line volume and the regulatory environment. The CEO himself admitted that their clinical initiatives to reverse the mortality trend, the GLP-1s, the advanced dialyzers, will take years to fully materialize in the data.
So it's a waiting game.
He explicitly cautioned that we might not see the full compounding effect on volume growth until 2028 or 2029. That is a very long runway where the CFO has to keep the plate spinning with buybacks alone.
And there was a much more immediate macroeconomic risk that the CFO flagged for 2026, something directly impacting their most precious asset, their commercial payer mix.
Yes. This is the critical risk factor every investor must monitor. During the pandemic, the federal government introduced enhanced premium tax credits for patients purchasing health insurance on the Affordable Care Act exchanges.
Okay.
These subsidies made comprehensive commercial insurance significantly more affordable for lower-income patients.
And as we established earlier, patients with commercial insurance are the lifeblood of DaVita's profit margins, subsidizing the massive losses taken on the Medicare population.
Exactly. But those enhanced ACA subsidies are currently set to expire. The CFO stated that they are modeling an estimated $40 million headwind to operating income in 2026 purely because of this expiration, and potentially a $70 million headwind the following year.
That is a staggering hit. If a patient loses that subsidy, their monthly premium spikes. They might drop their commercial insurance entirely.
Yep.
And because they have end-stage renal disease, they automatically default onto the government Medicare program, where DaVita's margin instantly drops to near zero.
The CFO did attempt to mitigate the panic by noting that established dialysis patients are incredibly savvy about their healthcare coverage. They know their life depends on it, so they will fight tooth and nail to keep their commercial plans, perhaps utilizing charitable premium assistance programs.
Sure, but what about the new patients?
Right. The newly diagnosed patients, the ones just entering the system, might let their coverage lapse before they fully understand the implications. The macro takeaway is clear. DaVita's margins are highly tethered to federal healthcare subsidy policies. If the government tightens the belt on the ACA, DaVita's bottom line feels the squeeze immediately.
So the overarching narrative is that the financial engineering is doing the heavy lifting right now. The buybacks and the debt repricing are bridging this massive gap, while management waits for their clinical initiatives to finally boost organic volume by the end of the decade, all while dodging the regulatory shrapnel of expiring subsidies.
It is a complex, high-stakes balancing act.
Which is exactly why reading the underlying mechanisms of the transcript is so vital. You cannot just look at the 33% EPS growth headline and assume the business is expanding rapidly. You have to understand the levers being pulled. This has been a phenomenal teardown of the plumbing of DaVita. But before we wrap up this deep dive, I want to leave you, the listener, with a final provocative thought. Something to mull over on your own that builds on the clinical data we discussed, but extrapolates it out over the next 10 to 20 years.
Let me guess. It involves the GLP-1 discussion.
It does. Management spent significant time highlighting how they are helping their current dialysis patients adopt GLP-1s to protect their hearts and improve survival rates.
Right.
But what happens when we look at the broader macroeconomic impact of these drugs? What happens when we zoom out to the tens of millions of Americans who have early-stage chronic kidney disease, hypertension, and diabetes, decades before they ever need a dialysis machine?
You were talking about upstream disease modification.
Yes. Recent clinical trials are showing that GLP-1s don't just help with weight loss, they actively slow the progression of chronic kidney disease itself. They reduce proteinuria, protein leaking into the urine, and preserve the kidney's filtration rate for years.
The data on that is incredible.
So, if these drugs become ubiquitous over the next decade and they fundamentally stop millions of people from ever progressing to end-stage renal disease, what happens to DaVita's pipeline of future patients? If the reservoir dries up, the core physical business of operating thousands of in-center dialysis clinics faces an existential crisis.
It is the defining long-term question for the entire nephrology space.
Yeah.
And when you view it through that specific lens, DaVita's $200 million investment into Alara Caring to build out home healthcare isn't just an operational efficiency play.
It's a survival mechanism.
It might be a massive, calculated, strategic hedge against their own brick-and-mortar obsolescence.
If the patient of the future never needs a massive, noisy in-center dialysis machine because their disease was managed upstream by advanced pharmaceuticals, DaVita still wants to be the company monetizing their care. They just want to do it in the patient's living room instead of a centralized clinic.
Exactly right.
It really makes you wonder, what will the traditional dialysis clinic even look like 10 years from now? Will it be a massive real estate footprint with 50 chairs? Or will it be a lean, digital logistical hub dispatching specialized nurses and advanced therapeutics into people's homes?
The landscape of medical delivery is shifting rapidly. The underlying biology remains the same, but the financial and logistical mechanisms to treat it are evolving at a breakneck pace.
And for the retail investor willing to do the hard work, willing to learn the difference between diffusion and convection, willing to understand joint venture accounting and shared savings models, unpacking these earnings calls is absolutely fascinating. Thank you for joining us on this deep dive. Keep your eyes on the data, question the mechanisms, and we will catch you next time.